Today we are diving into the put-call ratio or PCR and how it is an absolute necessity for your day trading strategy. We'll explore how to interpret PCR, especially in the context of the Nifty and Bank Nifty option chain, and how to incorporate it into your trading plan. Before we dive into PCR, if you need a recap on option basics and open interest, check out our previous videos from the links below. Let's get started. The put-call ratio is a sentiment indicator that compares the number of traded put options to call options. It's like a market mood ring, showing whether traders are leaning bullish or bearish. PCR is equal to the total put options open interest divided by the total call options open interest. Let's break down what different PCR levels might mean about the market mood. A high PCR, which means greater than 1. So that means there are more puts than calls in the open interest. Option sellers are comfortable selling puts, indicating bullish sentiment. However, a PCR above 1.5 might suggest an overbought market, hinting at a bearish reversal. A low PCR, which is less than 0.5, which means there's more call option open interest than puts. Option sellers prefer selling calls, signaling bearish sentiment. A PCR around 0.3 to 0.5 could mean an oversold market, suggesting a bullish reversal. PCR is equal to 1, which means puts and calls are traded equally, indicating a neutral market sentiment. Using PCR as a contrarian indicator. Here's the twist. PCR is often used as a contrarian indicator, which means that when the PCR shows most people are bearish, that is thinking that the market will go down, it might be a good time to consider buying. And when most people are bullish, thinking the market will go up, it might be time to consider selling. How I use PCR with the Nifty option chain. There are some golden rules I like to follow. So if today's PCR is lower than yesterday's, this could be a signal to consider short trades, that is betting on the market going down. If today's PCR is higher than yesterday's, this might be a good time to look for long opportunities, betting on the market going up. However, remember to use PCR alongside other tools and indicators to get a full picture of the market before making any decisions. Imagine the market is overwhelmingly bearish. Everyone's shorting stocks and buying puts. With all market participants bearish and now sitting on short positions, a very interesting thing takes place. There is nobody left to sell. That's when the market might start to rise, triggering stop loss orders and creating buying pressure. The Nifty option chain and understanding PCR and spot price. The Nifty put-call ratio live chart is a valuable tool for day trading. Here's how you can use it. Increasing PCR during a correction, but the overall trend is up. This is a bullish signal. It means traders are writing more puts, that is betting on the market rising after a dip. You should check how much the market has pulled back and consider entering a long position. Steadily rising PCR along with Nifty spot price. This indicates a bullish market. It means both the price and the sentiment are pointing upward. Declining PCR near a resistance level. This is a bearish signal. It suggests that traders are becoming cautious as the price approaches a level where it might struggle to go higher. Declining PCR during a downtrend correction. Another bearish signal. It means more traders are writing calls, betting on the market continuing to fall or exiting their put positions. Limitations of PCR. While PCR is a helpful tool, it has its limitations. Lack of context. PCR doesn't tell you why options are being traded. For example, large institutions might be hedging their positions, which can skew the results. There's a delayed reaction. The market doesn't always respond immediately to PCR extremes. Sometimes the PCR might stay at high or low levels for a while without a market reversal. Always have a backup plan in case things don't move as expected. Noise. Daily fluctuations can be misleading. It's better to look for consistent patterns over time rather than relying on one day's data. The put-call ratio is a powerful tool to understand market mood and spot potential turning points. Remember to use it with other indicators for a more complete picture. Thanks for watching and happy trading.